Hi, everyone. My name is Ben Swett. I'm the editor of the SeniorCare Investor, and today I'm joined by Don Kelly, who's the managing director of Locus Point Capital, where he's responsible for loan originations and structuring. Don also has more than 25 years of experience in the seniors housing and skilled nursing industry, and he's also been involved in the originating, structuring, and underwriting of approximately $5 billion in transactions. So, Don, you seem like the right person to turn to for all of our lending questions.
Well, thanks for having me this morning, Ben. Always good to connect with you and the Senior Care Investor.
We're happy for you to join us. So I'll start with a simple question, but I'm sure it has quite a complex answer. But we'll just start with, how has the lending environment changed from this summer, where things started to look up, there was some optimism in the air, deal making started to happen again, to now December, where we've got winter ahead of us, positive vaccine news, but I think people's outlooks are a little more dim right now. So how has the lending environment changed from the summer to now?
Yeah, I think it's kind of interesting. So we saw, cases, on the rise from the March timeframe up until like May, and then it seemed like it started kind of tempering a little bit. And so as kind of cases dropped up until approximately June, I think people felt like a little bit of positive news and felt a little bit better about kind of the perspective of kind of maybe what this virus kind of was confronting us with. And so I think there was some uptick in sentiment, and as a result, maybe we saw a little bit of activity. Once we got to late summer, we've seen a couple of ups and downs, and really over the past 3 months, we've seen cases just go up and up and up. So from the summer, where maybe we, as an industry, didn't feel like it was going to be maybe quite as bad, or we had kind of seen a fair amount of kind of the cases kind of matriculate through. I think from, like Dr. Fauci's perspective, that we're going to see this kind of second wave. It's probably a lot bigger than I had even anticipated. And so, I think the most recent news was over the last couple of days, we've almost hit 200,000 cases across the United States in a couple of those days. And we weren't seeing numbers anywhere close to that over the summer. And I think in large part, that's what's kind of different between the summer and today, is just that perspective. Now, with that said, I think we do have some good news with the vaccine. I think that's providing some level of clarity. So, I think we have, better data, better kind of empirical evidence, some better perspective about maybe kind of where we are in terms of this virus, and kind of maybe where the finish line is. I think the finish line's out further than we had probably anticipated it would be. I think a lot of us probably thought that, by the end of the year, maybe we'd be in pretty good shape and we would have smoked this thing out. But it looks like it's going to take a lot longer than that. So, I think that's why the lending environment's kind of, people are still wait and see right now, and probably just really struggling to understand how best to underwrite transactions.
Mm-hmm. And have you noticed a specific shift in lender sentiment following the vaccine announcements from Pfizer and Moderna, and also from the CDC's recommendation that the first to get the vaccine would be the frontline workers, but also nursing home and assisted living residents?
Yeah, I mean, I think that's really positive news. I think lenders are confronted with a couple different things right now. So one is, what else is in their portfolio or book, right? So if you've got hotels and kind of corporate finance loans and office and retail, I think you're confronted with some challenging loans. And so a lot of lenders in the healthcare space also lend in those kind of spaces. And so I think the decisions being made from a lender perspective across the industry aren't necessarily only tied just to our industry by itself. It's just kind of all the other decisions that have to be made internally. And So I think that's number one. Number two is, what is each lender's perspective of, what cash flow is going to look like and what occupancies are going to look like. When you think about where we were, let's say in March or even over the summer, we were at occupancy levels that are higher than they are today. And, kind of industry wide, let's say on the seniors housing side, back in February and March, we were at like 88% from a national average, and then today we're probably 10 points lower than that. So really the starting point from an industry perspective is much lower than I think we had anticipated. So just understanding what the implications are to kind of census at the facilities. One would be financing, what that means for the cash flow, and what that also means from a coverage perspective, are all things that lenders are taking into consideration. And that's probably the biggest challenge, is to guess what that is, kind of map it out or project it, and kind of get an idea of how long that's going to last, or how long the headwinds are going to last, and when we think we can kind of get back to whatever a new normal is.
Mm-hmm. So can you tell us at all how Locus Point has been underwriting for both the census and cash flow recovery? And has it changed as 2020 has gone along? I imagine it has.
Yeah, no, it has. And I think, we're pretty pragmatic. So, we're a relationship lender. We're focused on supporting operators that provide really good care. And in order to give them the best opportunity to do that, I think, we as lenders have to be pretty patient and reasonable with how we kind of lay out our underwriting and our projections and also our covenants. And so, we've in loans that we've been, closing over the past 3 or 4 months, we're really tracking a very lenient and forgiving path as it respects to kind of what the cash flow projections are and what the census is supposed to look like. And so, I think the last thing we need is borrowers tripping over covenants. And I think we want to be as accommodating as possible and just make sure there's enough, liquidity on the balance sheet of the borrowers, and give them plenty of room to operate, really, and kind of track a path over the next 2 years that's reasonable.
Mm-hmm. And does your approach change when working with a skilled nursing facility versus an assisted living or independent living community?
No, it really doesn't change. I mean, I think the same latitude is required, and the same patience is required, at this time in the market. And so, we want to be kind of the best business partner that we can, the best lending partner that we can to our operators. And so I think just having reasonable expectations of where folks are going to, operate is the best that we can do.
Mm-hmm. And I know it's tough to put a date on it, but is there any kind of projection that you have for some return to some kind of occupancy normal for the senior care industry?
Yeah, that's kind of interesting. So, I mean, when you think about, if we go back to 2010, we had kind of occupancy softness and some challenges back then. And, I think it took from 2010 to 2019 to, improve, let's say 5 points or 6 points of occupancy. And so we're now down about 10 points of occupancy from just a year ago. And so I'm not so sure how long that'll take to return to normal. I'm not so sure a new normal is 88 to 90%. I think in every given market, it's probably totally different. It's a different underwrite, and there's different market factors in each locale, and also different by skilled versus assisted versus independent. So, in terms of like getting to a point where, facilities, especially assisted and independent, can have normal marketing traffic, that's all going to be dependent upon probably vaccinations and other factors. And so, in talking with a number of operators over the past week, they're definitely encouraged with the news from the CDC, and hopefully tomorrow there'll be kind of final approval for the Pfizer drug. But the application and matriculation of nursing home and assisted living residents, and also the employees, will take a while. And so, just asking a couple of our operators their opinion, I mean, it looks like, it could take 6 months to really kind of process through fully, the residents and the employees. And so we're talking June, right? To kind of get to a point where we feel like, some of these operators feel like they've been able to, get everyone kind of taken care of. And so, I mean, hope to goodness that it goes way faster than that.
Mm-hmm. And hopefully census doesn't continue to fall too drastically, but it almost surely can't get worse. Although, knock on wood.
Yeah. And I think many operators are doing the best job using kind of alternate kind of technologies and techniques, where they can do Zoom calls, and they're marketing in a lot of just unconventional ways. I think the biggest challenge is just that you're having a tough time as an operator getting the same level of traffic in, but we have the normal amount of mortality rates in the industry, or even higher now at this point in time. And so kind of the move-ins and the move-outs are kind of are kind of varied, and that's a challenge in keeping up. So some of these properties that we finance, they're keeping up with the move-ins. The move-outs are a little bit worse, or vice versa, depending upon the market and depending upon the state that they're in. And it seems like some of the states in the Northeast are having a little bit of a challenge, and with the virus.
Mm-hmm. I like the point that you made earlier that the new normal for a stabilized facility is not going to be the same, a couple of years from now, where 88% is considered stabilized. Then it's going to change market to market and based on what's going on the ground. So it seems like the pragmatic approach is the right one for financing those communities.
Yeah, I mean, I think when we look at it, it's like we're never going to know what the new normal is, and probably until we get there. But from the standpoint of having reasonable expectations on operating margins,
mm-hmm.
Because the reality is the cost structure, at least during this time, has changed, and will kind of cost structures and be what will normal look like? I'm not sure. Will there need to be more PPE over time, even kind of more permanently in some way, shape, or form? Perhaps staffing can have to be a little bit more expensive, or kind of higher levels of staffing, to be determined. Mm-hmm. But yeah, in terms of how we approach underwriting, I think we're just being reasonable on our expectations for operating margins and for census.
Mm-hmm. Turning to the short-term debt market, how have the terms, requirements, covenants changed for deals like that?
Yeah, there's a number of things that really stick out to me as I've observed transactions occurring over the last, let's say, 3 or 4 months. And so one is, many of the lenders out there, and this isn't everybody, but this is kind of from a market basket, this is an observation. It seems like anything with a 1.0 debt service coverage or better, has a chance of getting done. Mm-hmm. Deals below that really much more struggle to attract debt financing in today's market. It's not that they can't, but it's just the choices are significantly less. And so that's number one. Number two, requirement to have debt service reserves, capitalized interest, or cushion in the liquidity of the borrowers is really important. And it seems like also that non-recourse is tougher and tougher to come by. Recourse, especially personal recourse on kind of for smaller middle market companies, or corporate recourse for larger transactions is pretty important and pretty commonplace in terms of deals getting done over the past 3 or 4 months.
Okay. And are we at the same place today, underwriting wise, as we were back in March, April, and May?
Gosh, probably not really. So I think in March, well, especially like in March and April, as we were just trying to figure out what this was, there might have been some level of optimism that this might be a shorter term issue than it is. So I think at that time, most were guessing most were trying to figure out, what does this virus mean? How will it impact us? At the time, occupancies across the industry really hadn't started falling yet in February or even March. As we got to April or May, we started gathering more empirical evidence. But I think as we've seen kind of how challenging this virus has made the operating environment for operators, I think we're in a very much different spot than we were. I think probably had more optimism back then that might be a shorter term issue. I think now, kind of the practicality of all has set in, and I think we're all as lenders a lot more educated on what the challenges are for our operators, what it's going to take from a liquidity perspective. We now have quite a number of months of actual real data in terms of what the expense loads are relative to where the censuses are. And so I think that's definitely helpful. It may not be overly comforting, but it's definitely helpful, and it allows us to probably, better project and track kind of, what it's going to look like in the months to come. And so, I think we're smarter now. I think we have more data, and I think it allows us to project a little bit better and kind of work with our operators on tracking a good path for them over the next 2 years.
Mm-hmm. That's good to hear. Well, have you heard of any lenders getting out of the business, or probably more likely just taking a year-long pause?
I've heard lots of lenders having different perspectives of how they wanted to kind of approach this market. And I think, I hear a couple of things. Credit is super important, number one. Number two, kind of taking care of existing relationships seems to be a theme. And also just being pretty judicious with kind of the, opportunities they take. And I think, if you're a bank lender, also kind of preserving preserving tier one capital, right? That's pretty important for banks. And obviously, if you ask some of the true bank lenders out there, they could probably give you kind of other considerations. But it just seems like right now, credit's king, taking care of existing clients, and just trying to be conservative in this environment and preserve some capital.
Mm-hmm. Okay. Last question, Don, but it's a doozy. How will the lending market change in 2021? And that in terms of activity, terms, rates, the distressed debt market?
Yeah. So, well, the distressed debt market. So that's one that, as I've talked to a lot of people out in the market, I think many have felt like at some point in time there will be some distressed debt opportunities, and I think as time and time has gone on, it's like it just never quite arrives. And so I think that's positive. It just means we have a resilient industry, and that if a property is seeing challenges and needs to be sold, and even if there's limited cash flow, there seems to be buyers for the properties. And so there's also seems to be lenders that will refinance other lenders with new structures, maybe better collateral, in terms of liquidity and other covenant requirements. But it just, I haven't really seen true distress in the debt market at this point in time. Distress in a debt market does provide opportunity for some folks, but I think I'm glad from our industry's perspective that we're not seeing a lot of it right now, because it just means I think we've got a pretty favorable and strong industry. In terms of 2021, in terms of what do I see for the financing markets, I think a lot of lenders are optimistic that, they'd like to do a good amount of business next year. I think that'll all depend on, just kind of where we are in terms of occupancies and EBITDA, margins, and kind of, how do we start creeping back to what a normal is? And, when will lenders feel kind of a little more comfortable having kind of a line of sight towards, when, normal occupancies and margins will kind of return. And I think once the vaccination starts being administered, the closer we get to kind of the end of that picture, I think will provide a lot more clarity as to when people can feel confident extending more credit or capital to operators. And maybe that'll help the M&A market kind of rebound a little bit. You'll see a little bit more transaction activity, which will obviously provide more opportunities to us as lenders in the market.
Mm-hmm. Yeah, you think that with each deal that closes, each transaction that gets done, lenders, buyers, everyone just gets that much more comfortable with getting deals done right now. So that hopefully that results in a very, very active 2021 for everyone.
Yeah, I think everyone would be pleasantly surprised if that happened, and probably relieved.
Hopefully. All right,
Yes.
Don. Well, thank you so much. Thank you for your insight, and good luck to you in the new year.
Thanks. You too, Ben. Appreciate you guys having me on.
Thank you, Don.